This is frequently asked questions about infinite banking and the TFCGW strategy, brought to you by SC FSIC. Aloha, I'm Stan Cox, Principal Broker and Finance Strategist at SC FSIC and author of the books on the Tax-Free Cash Growth Warehouse Strategy.
I'm Amanda Cox, President of Hawaii Financial Freethinkers Academy and Finance Strategist with SC FSIC.
One of the premises put forth in Nelson Nash's books about the infinite banking concept is that you pay yourself interest. That is, when you take a policy loan, leveraging the cash value of your account, you should pay back the loan with interest.
Of course, that's a great idea. If you took a loan from any other source, you would pay interest on the loan. How much better to borrow from yourself and pay yourself interest as you repay the loan?
That whole idea has been repeated by most all practitioners who work with the infinite banking concept. The problem is, it's not exactly true. I know of only one company that will allow you to actually pay more into your account just because you want to, and without somewhat cumbersome process. That company is not our first choice for IBC-TFCGW accounts, for other reasons that are, in my opinion, more important to the TFCGW strategy.
Such as higher dividend interest with lower policy loan interest and direct versus non-direct recognition. We have other videos that discuss those important subjects.
For this video, we want to clear up what is actually happening with the interest charged and paid on policy loans and how you can actually pay yourself interest.
First, we use mutual companies for our IBC-TFCGW accounts, primarily because with mutual companies, the policyholders are actually owners of the company. Therefore, the whole life policies with those mutual companies are participating policies, in that they participate in the dividends declared by the company on an annual basis.
Yes, and that means when the company is profitable, dividends are declared and paid to the cash value of the participating policies. One of the largest pieces of these mutual companies' investment portfolios is policy loans. So, the interest paid to the company on those policy loans contributes to the profitability of the company. Therefore, a portion of the policy loan interest that you pay on your policy loans does come back to you by way of the dividend interest that is paid to your account.
But the way Nash and so many others state it, it sounds like all the interest you pay on your policy loans is going directly into your policy cash value.
Sounds like, but it does not. Only a tiny fraction of it does.
And you can't just tell the company, I want to pay more on you're charging me for interest on my loan, and I want the extra amount I'm paying to go directly into my cash value. It doesn't work that way.
No. So, first of all, you don't actually borrow from your cash value. You borrow from the insurance company, and your policy cash value is used as collateral for the loan. That's how you leverage your cash value. Then, of course, the interest that you pay on your policy loan is paid to the insurance company, not directly to your account. The dividends the company pays to your account will be based on the profit the company made the previous year, and the interest that you paid to the company will have contributed to that profit. So, in that sense, you do get some of that interest that you pay back.
So then, how can you pay yourself interest in the IBC-TFCGW strategy?
It's a matter of planning for taking leverage loans and planning in advance the interest that you will pay to yourself. Even so, it's not usually directly correlated. It could be, but it usually isn't. That is, if you plan in advance when setting up your account that you will take a leverage loan of, say, $1,000 each month, and you want to pay yourself interest at 10%, you could plan for and schedule an additional $100 a month that you will pay on top of your regular premium.
But if one month you take a $2,000 leverage loan, you can't just add another $100 to that scheduled additional payment.
How then do you schedule these extra interest payments?
Answer: by scheduling paid up additions into your regular premium payments.
Yeah. Once you schedule those PUA premiums, and those do go directly to your cash value, they're included in your premiums due. You can change the amount of scheduled PUA payments, but there is more involved than simply calling the company and telling them, I want to change the PUA payment this month. You can pay a lesser amount without any big humbug.
But in order to pay a larger amount requires paperwork and usually additional underwriting, which requires additional paramedical exams.
So there are 5 ways that you can contribute to the cash value of your TFCGW account. Scheduled PUAs is one of them. And yes, there's the possibility of adding unscheduled PUAs as well, which also contributes to your cash value. And I say possibility of adding unscheduled PUAs because typically that requires underwriting and medical exam.
And based on the results, you may or may not be approved for adding the unscheduled PUA.
You see, by adding PUAs, you're actually adding whole life insurance benefit to your policy, and that increases the liability and risk to the company.
And they have the right to decline your unscheduled PUA.
To recap, paying yourself interest amounts to planning for and scheduling PUAs or paid up additions into your premium payments.
In that way, the extra money you pay will go directly into your cash value.
And you can consider it paying yourself interest. We hope this clears up the idea of paying yourself interest with the infinite banking concept, tax-free cash growth warehouse strategy.
And please post your questions and comments here in the comment section. And if this has been helpful to you, please like the video and subscribe to this channel.
Aloha and mahalo for watching.